You can stick with a hardwired strategy when it comes to investing. Choose the stocks you like one by one, or select Sector Spider ETFs and add the diversification of an entire sector of the S&P 500, like technology, with liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Being a millennial means you're young, and while it's great to have youth, it's vanity unless you put it to good use. Hi there everybody, I'm DeLegge with ETFguide. It's been said that a good plan today is better than a perfect plan tomorrow. Now this is particularly true when it comes to saving and investing. The sooner you get started, the better. Before we talk about investment plans, I have something to share with you about the millennial generation. We're talking about people between ages 18 and 33 that's really bothering me. From an investment angle, millennials have been stereotyped. They are slackers, they are stock market skeptics, and they are too spooked to invest in financial markets. Now these are just some of the stereotypes and misleading views that are being promoted today by the financial media and elsewhere. Now if you're a millennial, ignore these empty classifications. Do what you need to do to get ahead financially, and don't let anybody tell you that you're not capable of achieving a positive outcome. Now I'd like to share 4 simple but robust investment strategies for getting and staying ahead. Step number 1, pay yourself first. One excuse for not saving and investing that millennials sometimes use is this erroneous argument that, well, I want to pay off my debt, my student loans, before I start saving money. Why doesn't that logic hold up? Because eventually your student debt may someday be replaced by other debt like a mortgage. And if you train yourself to always delay the discipline of saving and investing because you're in debt, guess what? You're never going to get started. So regardless of how much debt you have right now, millennials should be saving and investing a portion of their income, no matter how tiny that income may be. Also, the amount you save doesn't matter as much as the disciplined manner and staying on track. Now, paying yourself first right now and continuously without let up over the coming decades, that's what really matters, and that's what's going to help you get ahead. Step number 2, build on a rock-solid foundation. After you've made that grown-up decision to save money, the next question becomes, well, where do I invest? The logical place to start is on a solid foundation of low-cost and diversified funds that hit the 4 major asset classes: stocks, bonds, real estate, and commodities. Now, some of the low-cost index ETFs that are out there are outstanding portfolio building blocks, and they cover these major asset classes. I'm going to give you a few ticker symbols. For U.S. stocks, you've got ticker symbol SCHP. For international stocks in developed markets, you've got ticker symbol VEA. For emerging market stocks, ticker symbol VWO. For total U.S. bond market, ticker symbol BND. For commodities, ticker symbol GCC. And for global real estate, ticker symbol RWO. Now check with your broker or your investment advisor if you have one. Some of these ETFs may be available as commission-free trades. Step number 3, prioritize your investments. Constructing a well-built investment portfolio is like constructing a home. You cannot build the second and third story of your structure until you have first built the foundation. Similarly, a diversified portfolio with foundational or core exposure to the major asset classes via low-cost and diversified ETFs is the only logical place to begin. Only until after you've built your portfolio on this type of solid foundation can you begin to experiment with non-core assets like individual stocks and actively managed funds and options and private equity and hedge funds and venture capital and so forth. The process of prioritizing your portfolio around core asset classes will also become your model investment blueprint for when you eventually have a 401k retirement plan. Step number 4 is to stay disciplined. Volatile markets, an economic recession, the Federal Reserve's next move, and all the daily happenings that none of us can control are not your enemy. In fact, you are your own worst enemy. And everything that happens with your money and your finances, good or bad, is your responsibility. If you fail, you're responsible. And if you succeed, you're responsible. Unless you commit to a disciplined savings habit, you'll always be like the masses, scraping to get by. And unless you take that savings and invest it in a disciplined manner with a logical framework, well, you'll end up also like the masses, always underperforming the market and wondering why. To recap, being young doesn't give you a free pass to be uninformed or to be lackadaisical about your finances. Now, the good news is, with just a little bit of effort, a little bit of discipline, and a mature view of money, you can and will succeed. I'm Ron DeLegge with ETF Guide.